Welcome back to the show. Let's talk to Tim Gregory, the co-founder and chief investment manager of Vermeer Investment Management. Morning to you, Tim.
Morning.
Let's talk about US results. It's the reporting season. Okay, is it going to be a good season?
I think it will be a good results season. The difficulty for some companies is that they will be reporting some special circumstances if they've been impacted by the hurricanes that we've seen tragically in Texas and in Florida. So there may be some companies that report impacted numbers from that, and I suspect the market will look through that and certainly should do. But the stocks going into the results season have been very strong, and my view would be that companies are going to need to produce good results in general to justify the sort of rises we've seen in markets recently. So it should be a good results season underlying, but it's going to need to be to justify how markets have traded in recent weeks.
But you look at it's closing highs almost every day. It's almost as you can almost guarantee that as much as Mr. Trump sending out a Twitter every night. So in terms of the markets, they always go into these and they underestimate the outcome. Okay, but in terms of valuations, so many reports I read that the S&P 500 and the constituents are overvalued. How, as a fund manager, do you factor in? Is it a question of you have to go with the crowd, or is it the fact that you don't want to miss the next leg up? Because on the bull side, some people are suggesting this has got a lot further to go.
Well, I think the situation has been that PE ratios for the market have been elevated for some time by historical precedent, and that has been a function of very, very low interest rates and very low bond yields. So if you're in the camp that thinks that rates will stay low for a sustainable period, and even if the Fed raises rates, which I suspect it will do in December,
and it plans 90% probability, something like that.
Indeed, and perhaps more importantly, how many of the 3 interest rate rises that they plan for next year will they actually manage to achieve? But if you think that as they raise rates, people will worry about the longer term impacts on the economy, and actually the 10-year yield curve doesn't steepen particularly, then higher valuations for equities can be sustained. And so my view would be you've got to, rather than focus on the index level, which, as you say, sort of grinds higher every day, you've got to look at the companies within that you think are going to produce results that are going to justify the lofty headline valuations that they're at. Businesses that are generating lots of cash, growing organically, that can justify those ratings. And that will be a challenge because markets have been very good, and some stocks that are very in favour are even higher than the overall market average. You're seeing some stocks in the low 20s multiples. They've got to have really good numbers to push on from here.
Okay, so my last question is October. It's a bad month for the stock markets historically, and I don't want to predict anything. Have you got a few out-of-the-money put options on the back book, just protecting some downside?
No, we don't. We have a little bit of cash in our portfolio, which we tend to have, which keeps some powder dry for new ideas. I think, if anything, in the very short term, there's a chance that this slow, grinding, day by day, as you sort of referred to, only up a little bit, but keeping edging higher, that could continue for some while, actually. I mean, obviously, what we don't know is what can come from left field, but on the evidence of what we see between now and the year-end, markets might continue to grind higher. So we don't tend to have puts and things like that in our portfolio, but we have a little bit of cash, just really to look for new opportunities.
Tim, thank you very much indeed.
Thanks.